Hello everybody. Thank you for having the faith in me because it takes a lot of enthusiasm to spend your Saturday morning listening to boring update about the Vietnamese stock market, but I'll try my best to keep you entertained. The very fact that there's so many people here on a Saturday morning is obviously testimony to the growing enthusiasm in Vietnam, not just in the region, but pretty much globally. A couple of years back, very few of our clients internationally really cared much about Vietnam, but the situation's changed significantly. But this is also an interesting time to be talking about Vietnam simply because of how the market has been behaving in recent weeks. So let me just jump into our explanation of why the market's acting the way it is and how we think you should play the Vietnamese stock market in the next, let's say, 1 year from now. So let me start out by, explaining why the market has actually corrected so sharply and why it's kind of moving sideways. Last year, Vietnamese equities were really in vogue. They were famous because Vietnam was one of the best performing stock markets in the region, rising by nearly 50% in 1 year. Come this year, the first quarter of the year was very, very positive as well, and Vietnam was one of the best performing markets in Q1 before this big correction that happened in May. And the fact is that in the short term, we don't see a sharp reversal. We don't see this as a pause before another bull market, simply because there are no supportive factors in the market at the current point in time. Market liquidity has come down, there is no real catalyst to warrant a reversal of the current weakness. Interestingly, last year, towards the end of the year, we had made a similar presentation in Thailand, and we talked about the fact that large caps really were the driver of the stock market in Vietnam. And we also felt that the gap in valuations between large caps and the rest of the market was actually too big to be sustainable. And come this year, I guess our prediction kind of played out because large caps saw the biggest correction in the market. As you can see in the chart to the left, the market correction was largely driven by a correction in the large caps, right? That being said, a lot of people predicted that money would move into the mid-cap and small cap space. That never really happened because the chart to the right here shows you that market liquidity is still dominated by large caps, right? So Vietnam's market and the VN index in general is still very much a large cap driven story at the moment. What about sectors? If you look at a sectoral level, you can see that cyclicals, your classic cyclical sectors, real estate and banking, for instance, really were the biggest drivers of the rally last year and early this year, but they also experienced some of the sharpest correction. Banking stocks in particular, which is the orange line on this chart here, you can see experienced a very, very sharp correction, right? Why is this? My personal view is that Vietnam's market did not correct for any reasons that were domestic, really. The market correction had everything to do with the global macroeconomic environment. And one of the biggest concerns globally, as you might well be aware, is tightening liquidity, right? US bond yields are going up, the Fed is reversing quantitative easing, Fed rate hikes are well in action, LIBOR spreads over treasury yields have also been rising, and therefore, obviously in an environment of tightening global liquidity, one of the first sectors to get hit is going to be the banking sector because there's concerns about interbank liquidity coming down, credit growth declining, etc. But I think the correction was overdone, and the reality is that Vietnam is still in, maybe not the middle, but at least 60% through this current business cycle, which means there is still some residual upside to be had. And investors realize that banking stocks should not have corrected so much because there is a good 2018 picture for banks. And as you can see, cyclicals, again, banks and property in particular, have also dominated market liquidity. Most of the trading in the market is happening in those sectors. One of the worrying things is that market liquidity has declined significantly, not more than $100 million a day in ADTV, right? Now, at least towards the end of 2017, beginning 2018, market liquidity was hitting about $300-400 million. In some cases, it hit almost $800 million a day when there were some big listings. So the fact of the matter is that Vietnam's landscape or market has changed dramatically even in 1 year. It's become far deeper and far more liquid. But ever since this recent market correction, as you can see in the chart to the right, liquidity has been steadily coming down. So is this something you should be worried about? Not necessarily, because the reason liquidity is coming down, in our opinion, is that a lot of foreign investors, which actually drove the market in 2017, are a bit nervous. Not about Vietnam. They don't doubt the fundamentals of Vietnam. They're worried about risk assets in general. And all frontier markets and emerging markets have seen outflows of capital. But can you really put Vietnam into the same category as Argentina and Turkey? Absolutely not. And I think what's happening now is investors are getting a little more discerning. You cannot use one umbrella term for all emerging and frontier markets, because countries like Vietnam are vastly in better shape macroeconomically than markets like Argentina and Turkey. So I think this liquidity decline that you're seeing will reverse eventually once investors begin to regain confidence. Market capitalization now is continued to surge. Actually, just in Q1 of the year, or the end of this, the beginning of this year, market cap to GDP was only about 78%. It's already at 86.5%. So the reality is, market correction or no market correction, there are new listings coming to the market. IPOs continue, and they're a key driver of the market expansion. If you look at the chart to the right, it's very interesting, because it shows you that not very long ago, there were not more than $7 to $9 billion market cap stocks in Vietnam. Fast forward just by a couple of years, and you have 31 names in Vietnam that are more than $1 billion in market capitalization. This shows you how dramatically the market has expanded, how deep it's become relative to just a couple of years back. And this theme will continue because there's a huge pipeline of SOE, state-owned enterprise divestments, and there's also quite a few private sector companies that are still in the pipeline for listing. If you look at the market valuation, there was a lot of talk about Vietnam being too expensive. People were looking at the price to earnings multiple and saying, can a frontier market really trade at 21 times earnings? It looks a bit excessive. And we agreed with that. We were of the view that the market multiple was not necessarily sustainable. But the important thing to realize is it was not the entire market that experienced an expansion in valuation multiples. It was large caps that drove this. And it was a few large caps. So the market valuation increases or expansion last year and early this year was driven in a very concentrated manner by a few large, select large cap stocks rather than across the board, which means there are still pockets of deep value in the Vietnamese stock market, and it's not fair to say that the entire market was overvalued. That being said, you can see that the correction in the market has also been driven by large caps. You can see the PE multiple of mid and small caps has basically stayed pretty much the same. It's the large caps that went up, it's the large caps that actually came down. But, again, as I said before, why is the market correcting? Why have valuation multiples come down? Is it because people have lost faith in the Vietnam story? Well, not really, because one of the biggest factors, as I mentioned, is a tightening of global liquidity. Look at this chart here, because it shows you the spread between Vietnamese government bonds and basically the US 10-year Treasury bill, which is universally considered to be a proxy for risk-free rate of capital. I mean, that is quite unprecedented. Less than 200 basis points is the spread between, T-bills and the government bond yields and what is still a frontier market. Is that really sustainable? No. And in fact, as we had predicted a month or two ago, Vietnamese government bond yields have to rise. There is no way this is sustainable, especially given the fact that both LIBOR and US T-bills are seeing rise in yields. So what does that mean? Why am I talking about Vietnamese government bond yields? The reason is that Vietnamese government bond yields are highly correlated with the price to earnings multiple of the market. So this chart here shows you, actually this chart here on slide 15 shows you the historical relationship between Vietnamese government bond yields and the price to earnings multiple of the Vietnam index. You can see very clearly that there is an inverse correlation between the two. That means that even in a frontier market, investors pay attention to yields on fixed income. And this chart here actually reinforces that point by showing you again that there is a very strong linear inverse correlation between government bond yields and the price to earnings multiple in the market. So let me go back a little bit now. So again, one of the factors that's driven the market correction has been a global tightening of liquidity. This has not only impacted Vietnam, it's impacted a whole host of emerging markets. The US dollar has also been strengthening, as everybody knows. In the beginning of the year, every economist that you talked to said, well, we believe the US dollar is going to be pretty weak this year. It's going to be in Mr. Trump's interest to keep the US competitive, reduce the US trade deficit, etc. Well, none of that really happened. The US dollar has been strengthening continuously. And this obviously, combined with rising oil prices, makes any country that is a net importer of energy, right, a little bit less stable on a macroeconomic footing. Vietnam is not as exposed to a rise in oil prices as, let's say, countries which run a large current account deficit, like the Philippines, for instance, and certainly countries like Turkey. But Vietnam is also impacted by rising oil prices, right? And Vietnam will definitely see inflation come back later this year as a result of the recent increases in oil prices. And because oil prices obviously are traded in US dollars, the rise in the US dollar index combined with the rise in oil prices is kind of like a double whammy in terms of the energy import bill. The other point I'd like to make, I mean, I'm preaching to the choir here because obviously I'm in Thailand and you know exactly what's going on here. But what is very interesting is in 2017, two big countries that pumped a lot of money into Vietnam were Thailand and South Korea. South Korea was very big in foreign direct investment, but Thailand was also big in FDI, but perhaps more important in terms of FII, portfolio flows into the stock market. But last year, a lot of Thai investors were very bearish on the Thai economy. People were worried about political instability, people were worried about weak economic growth, etc. Things seem to have changed in Thailand. Perhaps you can tell me better, but my impression is that things seem to be improving in Thailand, and that's reflected in a bunch of different metrics. I'm not saying Thailand has suddenly become as attractive as an early stage market like Vietnam, but the differential in attractiveness between the two markets has come down. And as you can see, the chart to the bottom right also shows you what's happened in South Korea, right? And that was actually solidified in the recent summit in Singapore between Mr. Kim Jong-un and Mr. Trump. The risk rating, the geopolitical risk rating of South Korea has come down significantly, which means that a lot of South Korean investors are now saying there might actually be opportunities at home, and maybe we don't need to park all our money overseas in markets like Vietnam. So that's something to be mindful of, right? But that being said, Vietnam still remains one of the most attractive markets in its asset class. And this is reflected clearly in the fact that Vietnam has seen continued cash inflows, net cash inflows into the equity markets from overseas, despite the recent market correction. This, I mentioned, is bound to happen. Vietnamese government bond yields are rising. And in fact, the last few auctions of long-term Vietnamese government bonds, 30-year bonds, have actually been failing, right? Which shows you that investors are now starting to demand a higher yield to buy into Vietnamese government bonds. And as I said, this is very, very strongly inversely correlated with the market PE. But what is good news is that on this chart, I've actually shown you the current market PE, which is about 19 times or 19 and a half times. And you can see that at the current market PE, historically, government bond yields on the 10-year notes were around 4.4%, which means that at the current level of government bond yields, the market valuation is justified based on historical data, right? If government bond yields rise further, which they will, the market valuation should theoretically come down slightly. But the good news is that earnings growth will continue to support the market even if there's a contraction in valuation multiples. And coming to earnings growth, you can see here that when you look at Vietnam just on a PE basis, it still looks expensive, right? 19 and a half times for a frontier market, especially because a lot of emerging market valuations have come down. But you cannot forget the fact that Vietnam is seeing some of the best earnings growth prospects in the region. Hence the PEG ratio. And if you look at Vietnam on a PEG basis, which is the orange line, you can see that it's still one of the best value destinations in the region, right? Adjusted for growth, you're actually not looking at valuations being as expensive as they appear when you just look at the PE number. But what is also interesting is if you look at the chart to the right, we actually looked at the PEG ratio based on the different tiers of the market. So you got the VN index overall, you have the VN30, which is a proxy for the large caps, VN mid caps and VN small caps. As you can see, the VN mid cap index has seen a continuous decline in the PEG ratio. Earnings growth remains very strong, but that's not reflected in valuations. This to us is not sustainable. And we think eventually investors will realize that there is serious value in the mid-cap space in Vietnam, and eventually mid-caps will see a re-rating. When exactly this will happen, I really can't tell you, but I believe it has to happen within the next year or year and a half. And in fact, you can see at the beginning of the year, we looked at the VN30 PEG ratio and we said, the VN30 PEG is almost double the VN mid-cap PEG. This doesn't make sense. Come mid-year, and that's exactly what we predicted has happened because the PEG ratio of the VN30 is actually contracted from 1.45 to 1.1. We now think that the time has come for the mid-cap PEG to actually appreciate so that the gap between the two starts to finally narrow and make sense. Foreigners continue to be a key driver of the market, which is exactly why I mentioned before that the re-rating of South Korea and the improving macroeconomic environment in Thailand could be short-term headwinds for the Vietnamese stock market because it's still driven by foreign capital. And the chart on the right shows you that even with the recent correction and capital outflows, foreign trading as a percentage of total trading value is at the highest level it has ever been in the history of Vietnam stock market, right? So foreigners continue to drive the market, and therefore when you think about where is the VN index going to go over the next year, you have to look at global factors. Because even a slight rate hike in the US, a change in the risk environment for emerging and frontier markets will have a disproportionate impact on the Vietnamese equity market. It's a global game and the drivers are global. It's not just about what's happening in the country. That's all I have. I will open up for questions. Questions popping up here on the screen, so I'm just going to go through them in the order they were asked. I love the first question, what is your top pick? Somebody here is just saying, I get it all, just get to the point. Well, I think that there are a few names we really like. Huafat Group, which is actually represented here today by the CFO. We really like this name because we think that even though the property market in Vietnam is starting to cool a little bit, the government is under a lot of pressure to ramp up public spending. And one of the biggest threats to Vietnam's growth story long term is infrastructure bottlenecks. And the government realizes that. For the last 2 to 3 years, public spending has been very weak, and the government realizes that there are real bottlenecks building in terms of infrastructure, right? And so we expect that infrastructure spending will be ramped up because also the government has more fiscal room now than it did a year or two ago. The government debt to GDP ratio is below the 65% cap that is imposed by the Constitution. So we believe that demand for construction steel will be well supported by a pickup in public spending. Combine this with the fact that steel prices continue to rise, China is continuing to shut down excess capacity, and the price of iron ore actually remains quite soft. You might even see a margin expansion for Hoa Phat Group. And as Hoa Phat will tell you later, there's also a lot of capacity expansion in the plan, and this is going to be a concrete catalyst because the new plant, the Dung Quat complex, essentially will start operating later this year, right? And so Hoa Phat is probably, I would say, our top pick in the current environment. The second question is, do you think how much more the correction can go further? Okay, so I guess the question is, how much more will the market fall? You know, I was asked this question 3 weeks ago when the market continued just to, you know, be in free fall, and I said that this is irrational, right? You can't have such a sudden correction being sparked by global factors, because the reality is that Vietnam's macroeconomic fundamentals still remain very strong. In Q1, the trailing 12 months EPS growth of the market was roughly around 23%, right? That's a very, very strong number. And in Q2, we expect that corporate earnings will continue to be very strong. You're looking at definitely north of 20% EPS growth. So can you really expect the market to continue to fall in an environment where companies are delivering solid earnings results, in an environment where the macroeconomic story remains intact, in an environment where you've got 6.6 to potentially 6.8% GDP growth? It doesn't make sense. And I think eventually investors are starting to realize you cannot put all emerging markets or frontier markets into one bucket, because the difference between a Turkey and an Argentina and a Vietnam is so vast that you cannot just say risk off, I'm going to run away and dump all emerging market equities or frontier equities. So I don't think the market correction can continue indefinitely. You've already seen the market recover, right? It's gone back above the 1,000-point psychological mark. I think the market is going to move sideways. There's going to be a lot of volatility. If the global environment dramatically changes, of course Vietnam will be impacted. But in the absence of a big global shock, I think the market has already bottomed, and I don't see it going below, let's say, 900 or 950 points in the foreseeable future. Next question is, banks in Vietnam are undercapitalized. What is your view in this sector? Capital raising? Yes, banks in Vietnam are undercapitalized, and the reality is that there's been extremely strong system-wide credit growth for the last couple of years. Credit growth last year was, I think, something like 17 or 18%, actually 18%. This year, credit growth is on track. If you look at 5 months, year-to-date credit growth is on track to be close to 20% again. However, we believe the second half of 2018 will see a deceleration in the rate of credit growth, because I think there are concerns now about inflation. But the most important factor is Vietnamese banks are meant to comply with Basel II regulations by 2020. This was originally supposed to happen this year, but it was delayed by 2 years. There's only one Vietnamese bank that's actually completed the Basel II implementation, and that's, I think it's OCB. So virtually every other Vietnamese bank needs to go through this process, and most of them, I'd say about 80% of Vietnamese banks, actually, if you apply the Basel II capital adequacy ratio, it's actually falling short. It's below the 8% threshold that is the minimum requirement. So this is a big challenge for banks. I don't think internal capital generation is enough to build up the capital buffers that are required. most banks need to get in external capital. But as you know, Vietnamese banks have a foreign ownership cap of 30%. This is a major, major challenge. There have been a lot of strategic investors, you know, for example, MUFG and Vietcombank. You had in the past HSBC and Techcombank. So there are a lot of these deals, strategic deals, and a lot of these strategic partners want to recapitalize the banks they've invested in Vietnam, but they cannot without breaching the foreign ownership limit. I think the only solution has to be a slowdown in asset growth and in credit growth. So a lot of banks now will start slowing down loan growth so that they can meet the capital adequacy norms. This is another reason, apart from what I mentioned about the government trying to prevent inflation coming back, that I believe in the second half of this year, you will see a pretty substantial slowdown in system-wide credit growth. The next question is, how about your opinion in case of increasing of public debt? It will have effect on economic growth or not? Well, I actually touched upon this before when I predicted that companies like Hoa Phat will be well supported by a pickup in construction steel demand. The hypothesis there is, I think the government will ramp up public spending. It's been very weak for a couple of years. The second reason I believe the government will ramp up public spending, apart from addressing infrastructure bottlenecks, is perhaps that credit growth has to come down. If credit growth has to come down to make sure that inflation is contained and the banks maintain pretty good asset quality and capital buffers, the government has to have something else support economic growth. And I believe that something else will be public spending. Vietnam has about, basically, public debt to GDP right now is about 63% versus 65%, which is the limit. There's some fiscal room there. Also, let's remember that Vietnam has been consistently divesting stakes in state-owned enterprises. And there are several billion dollars worth of capital coming into the government coffers from these divestments. The other thing is, Vietnam actually is a pretty big exporter of crude oil, right? And when oil prices were very low, the government earned less royalties from this. With oil prices up now, actually, the government's earnings, royalty earnings from crude oil exports, have basically more than doubled in the year-to-date period. So that will be an additional source of revenue on the fiscal side, which I think will allow the government to ramp up public spending. So the question is this bad for economic growth? Absolutely not. I think it could help support economic growth in an environment where credit growth comes down. Next question, any recommendation in mid-cap stocks? Yes, we do have recommendations in mid-cap stocks, and as I mentioned, I think mid-cap stocks are where the real opportunity lies, because large caps still continue to look quite pricey. In the mid-cap space, there are a few names we like. I'm not necessarily mentioning all the names that we closely cover, but we like a company called AAA, which is a plastic, the biggest plastic packaging manufacturer in Southeast Asia. This company has a very interesting strategy because it's migrating away from the commodity plastic bags market into higher-end value-added plastic packaging products, including biodegradables. And you know, this company also has a very, very solid client base overseas. They're selling into Europe, they're selling into Japan, which are some of the most quality-conscious markets. And combine that with their relative scale advantages, we think that AAA is going to do very, very well. And even though plastic resin prices or input prices are rising, because the company is moving into value-added products, it has the power to offset increasing input costs by increases in average selling prices. So that's a mid-cap name we like. To be honest, we also like some banks. There's a bank called Linh Viet Postbank LPB. This company actually listed last year, and we really like this bank because it's a bank that nobody really focuses too much on. It's a smaller bank, but the bank has some unique competitive advantages. It's one of the 4 banks in the country that is allowed to disperse pension payments to government employees, which means that it's a very low cost of funds versus other banks. It also has a very high CASA ratio, right? And because a large shareholder in this bank is Vietnam Post, which is the government postal monopoly, this bank has access to more than 10,000 postal transaction offices across the country, right? And these offices tend to be in underbanked areas of the country where there's very little competitive, the competition is very low. So we think that the combination of these huge potential branch networks, low cost of funding, and a continued reorientation towards segments with higher asset yields, like retail lending, will drive LPB's earnings, and LPB is trading at a huge discount to the rest of the banking sector. Only a little bit around 1 times book versus 2.2 times book for the overall banking sector. So we really like LPB. What do I think about ACV? I love ACV. But a lot of people look at me like I'm crazy because, the valuation of ACV is not exactly reasonable, right? From a short-term perspective. But if you actually look on an EV to EBITDA basis, ACV is actually trading at a slight discount to Airports Authority of Thailand, AOT, right? Now, of course, a lot of Thai investors will tell me, yes, but AOT is fundamentally different. It's at a different stage in its growth. It has the ability to run the duty-free retailing in its airports, etc. But you have to remember that Vietnam, in its aviation penetration, is where Thailand was probably 25 years ago. If you look at RPKs per capita, it's one of the lowest in Asia. Combine this with the fact that this is a full government monopoly, and combine the fact that Vietnam is seeing some of the fastest domestic air travel penetration growth, and Vietnam is also becoming one of the most popular international tourism destinations. It's actually a competitor with Thailand now, right? When you combine those two facts, you can see there are multiple engines which will drive more passenger throughput through Vietnamese airports. Long term, I think this is one of the best structural growth stories in Vietnam. I think I might be out of time. Can somebody tell me if I take a couple more questions?
Right.
All right.
Okay, they ask about, what about your opinion about Vietnam currently trend? It weakens over past year.
Sorry, can you repeat that?
What about your opinion about Vietnam currency?
Currency.
Trend? Right, sorry.
Right.
It weakened.
Sure. I think there have been a lot of concerns around the currency. I personally think Vietnam's currency is among the best supported in its asset class. Because even though there are capital outflows of portfolio money, the reality is FDI continues to be very strong. And I'm not just talking about FDI going into factories, but a lot of foreign strategic buyers are increasing their stakes in listed Vietnamese companies for strategic reasons. An example is Fraser and Neave, which has been increasing its stake in Vinamilk. You have Nava Plastic, the Nava Plastic industry of Thailand, which increased its stake in BMP. So basically, even though hot money is going to flow out, there's a lot of sticky capital which is coming into Vietnam for strategic reasons. One concern, however, is that the trade surplus that Vietnam saw is actually narrowing. And in the first quarter of this year, I believe you saw almost a trade deficit. And that's because export growth in Vietnam is slowing. And export growth in a lot of parts of the world are slowing at the current moment. Especially now, if you have greater trade protectionism, it will impact Vietnamese exports, right? So that might be a potential headwind and weigh on the currency, but I don't think the currency is going to fall off a cliff. You might see some devaluation this year. We had predicted about 2%. Might be a little bit higher than that, but I don't see a dramatic current correction in the currency. Moving on, according to North Korea, peaceful, how do you think about FDI from South Korea? I mentioned this earlier. I do believe that some of the FDI which would have left South Korea for Vietnamese shores will now be deployed within Korea. But let's not be get too ahead of ourselves. I mean, yes, the political situation has improved. There's a serious prospect of denuclearization of the Korean Peninsula, but that's not going to happen overnight. It will take time for that to materialize into actual investments by South Korean companies in North Korea. That being said, some big companies like Hyundai, for instance, are now seriously looking at deploying capital in North Korea, especially in improving the infrastructure connectivity between North and South Korea. So that will be a loss for Vietnam. But it's not going to happen overnight. Last question, I think then I'm going to run out of time. What is market earnings growth for 2018? And what's the earnings revision trend since Jan 2018? Market earnings growth for 2018, I think consensus growth is around 20%, close, it really varies, but generally it's around 20% EPS growth. Trailing 12 months growth as of the end of Q1 was actually 26% EPS growth. Our own personal view is for 17 to 20% EPS growth for 2018. In terms of market revision trends since January 2018, there actually is no data to tell us exactly what the rate of revisions is, but generally, in the last couple of years, corporate earnings have come pretty close to consensus or actually exceeded consensus estimates. So we don't see downside risk to those projections. 2019 is a different year. 2018, I think it's pretty close to 20% EPS growth. That's all I have time for, I believe. I think I'm out of time, so.